Hello everyone, my name is Hitesh and I welcome you all in our final chapter of Futures Learning. Now, over the course of last 5 chapters, we have understood what are forward contracts, what are future contracts, what is the spot market, difference between futures market and spot market, how are futures used to hedge in the market. You could hedge like a single stock portfolio, multiple stock portfolio. All these facets have been covered in the previous chapters. Now, through this last chapter, we'll be covering the concept of how to trade index futures. What exactly is index futures? How does it make a difference to your portfolio? How does expressing a view in the index by using futures contract makes a difference to your portfolio? We'll be covering all these facets in detail here. So let's begin our discussion on that. So when you buy shares of a company, you are expressing your view on a particular segment or a particular share or particular stock in the market. But what if I were to express my view on the whole market? I want to understand and express my view on a broader scale. How do I go about doing that? So the best and the easiest way to do that is through investment via the indexes. And the most active indexes in the market right now are the Nifty and the Bank Nifty. And recently on January 11, 2021, SEBI even allowed the trading of Nifty financial services in the futures and options market. So these are 3 basic indexes through which you can express your view on the whole economy. So one thing we have to understand, that indexes don't trade in the cash market. Why is that so? Because index is an amalgamation of various shares in the market. If I were to give the example of Nifty 50, Nifty 50 comprises the top 50 companies, or some people call it as a blue chip companies in the Indian equity market. So they are not allowed to be traded in the cash market. So you can express your view via trading futures contract, or maybe through options also. But we'll be talking about the concept of futures here. And just to put things into perspective, Nifty futures are one of the highest traded derivatives in the world. And if the facts are to be believed, then it's among the top 10 traded derivative contract in the world. So now let us try and understand these 3 different indexes in the market and how do they impact the futures market. We'll be talking about Nifty 50, Bank Nifty index, and we'll also be talking about Nifty financial services here. So let us begin our discussion with Nifty 50 index futures. So the underlying asset here is Nifty 50 index. And the total stocks in the Nifty 50 index is 50. As I've already mentioned, included in this index are the top 50 companies trading in the Indian equity market. The total contracts active anytime are 3. Basically, you have 3 futures contract active anytime. That is the near month, mid month, and the far month. If I were to be trading my futures contract in the month of January, then the 3 active contract will be the January expiry, February expiry, and the March expiry. And as and when the near month expires, another far month contract is added to the list here, and the mid month becomes the near month, and the far month becomes the mid month then. And the total number of shares in one futures lot is 75 for Nifty 50 index, and the expiry date is the last Thursday of every month. Basically, on every last Thursday of the month, the Nifty futures contract or any index contract or any futures contract expires. And if the Thursday is a holiday, then the expiry happens on the preceding day, that is the previous day, on Wednesday. So now let us try and understand how to calculate the index futures contract value. So if the present value of one lot of Nifty futures for near month expiry is 14,476, then the total value of the contract will be 14,476 into 75. Why? Because 75 is the number of shares per Nifty futures contract. So total contract will be 10,85,700 rupees. That will be the total contract value. And now let us try to understand that if I trading via different kind of trading, like the normal trading, the margin intraday square off, the covered order, bracket order, what are the different amount of margins required, or what are the amount of margins which we need to deposit in our trading account to be able to trade these futures contract. So if I'm trading via normal order, the amount of margin required will be 1,62,034. If you look at the previous slide, the total value of contract is 10,85,000 and the amount of margin required is 1,62,034 if it's for delivery purpose. That is, I want to carry my position till the expiry. And if I'm doing a MIS trade, that is a trade which gets squared off at the end of every day, then the amount of margin required is nearly 50,000 rupees. If I'm doing a bracket order, what happens in bracket order is this: when you place an order, you already pre-specify the stop loss for the trade and even the target for the trade. So the amount of margin required for that is 43,400 rupees. And similarly for a cover order, in the concept of cover order, it's very similar to bracket order. The only difference is you don't have to specify the target price, you just have to specify the stop losses. So the amount of margin required to trade bracket order and the cover order is almost the same. So these are different 4 kind of trades and the amount of margin required for each of them. Now let us understand the concept of Bank Nifty index futures. So the underlying asset here is the Bank Nifty index. Bank Nifty index comprises of 12 major banks in the Indian banking system. It's a combination of both public sector bank and the private sector banks. And the total active contracts are again 3 here, and that is near month, mid month, and the far month. And the number of shares in one futures lot of Bank Nifty index is 25. That is, you have 25 shares of Bank Nifty futures here. And the expiry is just like any other index. The expiry is on the last trading Thursday of every month, and if that's a holiday, the contract expires on the preceding day. So now let us try and understand the calculation of the contract value of index future Bank Nifty. So if the present value of one lot of Bank Nifty is say 31,628.05, that is a Nifty index value, then the total value of contract will be 31625.05 into 25, which is the number of share, which amounts to 7,90,701. So that is the total contract value. And now let us see the amount of margin required to trade these kind of contract under different kind of orders. So under normal order you need 1,60,000. For MIS trade you need 44,000, and for bracket order and cover order you need 43,034 rupees. So the amount of margin gets reduced as and when we have already specified the stop loss and target for it. And if the holding period is also smaller time, then the amount of margin required will also be smaller. But one interesting thing here is this: whenever we are trading the index as a futures contract, the amount of margin required, even if you're carrying a position for the overnight or the next day, it's almost like 15 to 20% of the total contract value, because of the less volatility and there are more players involved into it. And let us understand the next important index futures, that is the Nifty Financial Services future. This has been recently launched on the January of 11, 2021. So the underlying asset here is Nifty Financial Services Index. The total stocks in this index is 20. The total number of contracts active anytime right now is 4, and the number of shares in one future lot is 40. And the expiry again is the last Thursday every month, and if Thursday is a holiday, it expires on the preceding day. Now let us try and understand the calculation for the value of the contract. So if say on the present value of one lot of Nifty Financial Services is 15,308.30, then the total value of contract will be the current value of the Nifty Financial Services multiplied by 40, which is the number of shares, and which amounts to 6,12,332. So that is the value of one lot of futures index of the Nifty Financial value at the current market price. And under different types of order, the amount of margin required for normal is 1,17,957. For MIS is 38,000, and for bracket order and cover order, the amount of margin required is 31,750 in the market. So that gives you a brief understanding of different indexes and their futures contract, and what is the amount of margin required to trade each and every kind of contract for different types of order. Now, having understood the different kind of Nifty indexes, the Bank Nifty index and the Nifty Financial Services, let us try and understand why should one express their view by using the index futures? Why not individual shares? Why express their view on a bigger scale? The answer to that is very simple. First of all, it gives a diversification to your portfolio. Now, as I have already mentioned, if I were to give the example of Nifty 50 index, it comprises of top 50 companies trading in the Indian equity market. And if I were given the option to express my view on the broader sector, I would obviously want to diversify my portfolio, and nothing like Nifty 50 to express my view on the market, because I'll be putting my money in different sectors like the banking sector, the housing sector, the FMCG sector, the auto sector. Everything becomes a part of Nifty 50, and I'll be expressing my view at a broader scale. The market manipulation becomes difficult. How does that happen? If I were to trade a share of a particular company, it is very easy for a major player in the market to manipulate the share prices, which is not allowed, but it is still possible, and it might impact my profit and loss. But if I am trading the index as a future contract, it is very difficult to manipulate, because the number of players are large, plus the contract value is much bigger compared to individual shares or stock in the market. The margin required is lesser compared to individual stocks. As I've already mentioned in our previous chapters, that the amount of margin required for trading different kind of futures contract is different, and because it depends on the volatility and also on the reliability of the stock. If I'm trading the shares of a particular company, the amount of margin varies between 20% to 60% of the contract value. But in case of any index futures, the amount of margin varies between 12 to 18% of the index value, which is where the amount of margin required is comparatively lesser, and I get to express my view on a bigger scale. And highly liquid. Basically, this goes without saying that the number of players being larger in the market, plus it's a broader index, the amount of liquidity will be higher, because there will be more players interested or willing to take position than that kind of product in the market. And it gives you a broader picture of the economy. If I am trading one share of a company, of a particular company, I will be trading only on the fundamental picture of that particular share or that particular company. But if I'm trading an index, just to give an example of Nifty 50 index, I'll be trading on the broader picture of the 50 shares included in the Nifty 50 index, which ultimately gives us a broader picture of the economy, because there are 50 major players in the market and they have a major say in the function of the economy. So in a way, index future represents the broader picture of the economy. I hope this gives you a basic idea of why should one trade index futures in the market. Now let us understand what are the key takeaways from this chapter. The Nifty futures are the most liquid future contracts in India because it's highly traded, highly volatile, and the major players included in it. The Nifty futures derives its value from the underlying Nifty index in the spot market. The Bank Nifty index futures derives its value from Bank Nifty index, and so on. At present, the lot size of Nifty futures is 75 shares, for Bank Nifty futures is 25 shares, and for Nifty Financial Services futures is 40 shares. And if we trade via index futures, we are directly trading on the represented view of the economy. I've already told you, index is an amalgamation of major shares in the market. So if I'm trading an index, I'm basically trading on the broader picture of the economy. I hope these 6 chapters gave you a decent understanding of the futures market and its functioning. If you have any more doubts, please put your comments on our doubt section. We'll be more than glad to sort out your issues. I thank you for your patient hearing, and I'm looking forward to seeing other chapters which will be explaining the technical analysis, options trading, everything in the market. I hope to see you in the next chapter. Thank you so much.